All right, welcome back to another episode of, we're going to go with the Mitten Mortgage Lending Podcast for now.
Close enough for now.
If
You got a better idea, send it
It needs
over.
a name by this point. Yeah, we will accept better name recommendations
We're
for
still
sure.
taking applications for names, but,
Yeah.
but we're going to roll with that for now.
Yeah. So a lot of news going around in the mortgage industry from clients to everyone about the market and rates taking a dip. Everyone's hearing rates are going down. Rates are going down. Looking at it right now, the 10-year as we sit here today is at a 3.85, which it hasn't been below 4 in a real long time. So that's exciting news. Rates have come down. It's not, I still have had a few clients where it hasn't been like as much as they expected. You know, we're not in like the 5s or anything yet for some of these. Obviously, there's some specialty programs that can get you there. But I would say, generally speaking, good rule of thumb, if you do have good credit, putting down a solid down payment, something like that, we should be somewhere between 6.5 and that 7 range. You know, definitely if you're willing to pay a point or so, probably closer to that 6.5 range for sure. But Chris, what have you seen with the market?
Yeah, so I mean, you're pretty spot on there with your analysis, Mac. Like you said, 10 years below 4, which is awesome. We haven't seen that in a little while. And I always joke, like, I know a lot of people are calling, and they're calling the office, and they're texting us, and they're emailing us, which is exactly what we want. If people have questions, we want you to ask us. But usually, I always joke, if the news is talking about it, we're usually not quite there yet.
Yeah.
The news, I don't know, they always need something to talk about, I guess, right? Yeah. So they tend to jump the gun a little bit, I think, when it comes to this stuff. But the fact that they're even talking about it, or talking about rates going down, or talking about rates dropping, is a good thing for anybody who's even thinking about or wants to think about refinancing. Because we're not quite there yet, but we are close. Now, and when this starts happening, I feel like the market starts testing new lows. So we get a low, and then the rates will bounce back up a little bit, and then we'll get a new low, and then they'll bounce back up a little bit. So you're never going to time the market perfectly, but in an ideal world, like you may call. I had this happen to a couple people last week. They called in, we ran numbers, we went through everything, and a refi made sense for them. They waited, they thought about it, they talked to their husbands, talked to their wife, whatever, and we come back 2-3 days later, and because we were at that low when we talked, but a couple days later things floated back up a little bit, and now a refi might make sense, but it wasn't nearly as, I guess, attractive or nearly as interesting as it was to them before. So we're testing these new lows. A couple weeks ago, we got a really nice big rate drop all at once, and then pretty much every day since then, the rates crept back up. Now, we're not quite where they were. They're lower than they were, but it's kind of like I said, it's not perfect. We are testing new lows, though, which means hopefully it's coming soon. I know the Fed's talking about rate cuts that are coming soon, kind of the same thing. It'll be interesting. You know, people will call us and say, I saw the Fed meeting today. They said the rate cuts are coming. Great. We have to wait for those. We have to give it time to price in. We have to let the market adjust. So just because you saw it on the news, or just because you saw it, on the TV, or read it on Yahoo or the internet, or whatever your news source is, just because you see it there, doesn't necessarily mean it's the perfect time. But I don't know. It's weird. For a lot of people, there's savings, but it's like, how much do you want? What's enough for you? And what's enough for you is it is going to be a different answer for every single person out there. $50 a month might mean a lot to you, whereas $50 a month might mean nothing to someone. So it's super dependent on you, your situation, what's going on in your life, a lot of different things.
Yeah, I know we're going to talk more about refis here coming up too, but that's one thing that's kind of been a little bit surprising to me with the people that I have reached out to where refinances did make sense, that they still wanted to wait even more to see if it went down even more, which I'm like, well, we've been waiting for this for about a year now. And we're here where we can, take you from a 7.5 to a 6.5 or something like that. Like, we should look at this opportunity or even below that point. And that's the first thing they mentioned is like they wanted to wait even longer, which can be, I think it's a little aggressive. Like if you can save some money now, then go ahead and do it. You can refinance again, within 6 months.
Yeah.
So if rates do continue to drop, that's something you can again take advantage of down the road. I don't think you're missing out by lowering your payment right now.
I agree. And again, it's all relative, right? So I don't think, I'm not going to say this. I'm not going to say I don't think, but it's so dependent on your situation. In most people, if you're at a 7.5, going to a 7% most of the time probably doesn't make a ton of sense. Going from 7.5 to 7%. But going from 7.5 to 6.5% makes perfect sense all day, every day, pretty much no matter what.
Yeah.
But some people are like, oh, I want to wait to get to the fives. Well, guess what? If rates continue to come down, we'll just do it again. And I know a lot of people are, oh, we don't want to spend the money. But we don't have, when you're working with Mitten Mortgage Lending, you're not paying any junk fees. So when you call your bank or when you call one of these big lenders that has Super Bowl commercials and all this stuff, you are paying. You are pick one, but you are paying a ton of fees that you don't need to pay when you're doing that. So if you're calling them and you're dropping from 7.5 to 7, no, you probably shouldn't do that because you're paying several $1,000s in junk fees that don't need to be paid. So definitely don't do that. But when you're working with us, if we can drop your payment $100 a month and it's really not costing you anything, you're really only paying for your title work that you need to pay for, which we have some new special programs for some of our lenders that kind of replace title work, makes those costs a little cheaper. They give you a little bit of a rebate on your credit on the back end. So there's some ways that we can figure it out for you. But I guess, this whole conversation, what it leads down to is just call us. Call our office, email our office. Let us know if you have questions about refinancing. And I can tell you right now, if it doesn't make sense, we aren't going to let you do it.
I've had plenty of clients do that where, in the past couple of weeks I've said, hey, send me your most recent mortgage statement because I think there might be an opportunity here. And yeah, some we've been able to help out. Others, hey, we're still not there yet, but obviously I'm monitoring this, I'm tracking this, and when that opportunity does come, we'll be ready to pounce on it.
Exactly. And I know we're going to dig more into the refis here, but I'm in the same boat.
Go ahead. Just dig in. Let's dig into the refinances now.
When it comes to refis, and these are the conversations that we're having with people, when they're sending us those mortgage statements, there's pretty much three. There's more, but I would say in general there's three.
Main three.
Yeah, there's three different refis in general. You're either looking to lower your payment, you're looking to chop some years off and lower your term, so shorten how much longer you're paying on this house, or you're looking for some cash out. Now, the cash out we can break down. We can do a regular cash out on your home. We can also do a second lien, like a second loan on your home on top of your current mortgage. You can get a line of credit or just a second, like a lump sum. It's called a HE loan. So you can get a HELOC or a HE loan. But the three are every time someone talks to me about a refi, I would say in general, they're either looking to lower their payment, they're looking to shorten their term, or they're looking to take some cash out. In some cases, depending on when you bought, what your rate is, what's going on, we might be able to. I've had people, this is back when rates were 3%, but either way, if we drop you enough from what you're currently at, I've had people that have taken years off their mortgage, lowered their payment, and got a little bit of cash out. So not saying that we're going to be able to do that,
Those are the triple crown loans.
Yeah, we're not going to get the triple crown on everyone, but I mean, generally speaking, if we can check one of these boxes for you and accomplish some of your financial goals and put you in a better spot, those are the three that we get more often than anything.
Yeah, and if we can check two, I think that's to me that's where it gets to the no-brainer part.
If we can check two, well, first off, we're never going to make you do anything. But if we can check off two of these boxes, I'm going to strongly encourage you to do it.
Right. Right.
It's going to make a lot of sense, especially if we could put you in a better financial situation. We get a lot of people though that call and say, "Hey, Chris, I do not want to go. I'm in a 30-year. I've been paying on this thing for 2 years. I've got 28 left. I do not want to go back to 30."
And that's where flex terms come in.
And that's where the flex terms comes in. So we can still, let's say that example, let's say they're at a 7.99. They bought when rates were really high. Well, maybe they're a year in now. They don't want to go back to 30. They don't want to go backwards because one of their really long-term financial goals is to make sure that this house gets paid off. But they can't afford to do the 15-year, the aggressive payment or whatever the case is. Well, great. We'll refinance you and we'll put you in a 28-year or a 29-year, and we can start your new mortgage with 28 or 29 or 27. We can do anything between 8 and 30. So don't sit there and go, oh, I can get a better rate, but I really don't want to go backwards. That should not be your thought process at all. We're going to take your financial goals when you work with us, and we're going to make sure we listen to everything that you're looking for, and we're going to try to make sure we check off all of your financial goals. If one of your goals is paying your house off, that's fine. We're going to look at paying your house off, but also understand most of the time to pay something off sooner, it's going to cost you more, so you got to pay more. So we're going to be realistic with your goals, but we're definitely going to try to help you accomplish all of them.
And I think a lot of people that did buy, they are looking to lower that payment because a lot of them got the increase from the new tax bills that come up, which is already increasing their payment, which we ran into. I mean, I know I ran into that for the few conventional or even VA refis that we did put through in the past couple of months. The taxes were readjusting, so I was like, hey, you're saving your principal and interest payment, that's going down $250 a month, but your escrow payment is going up 90. So like it's not going to look like 250, it's going to look more like 160. But at the end of the day, those taxes and that escrow, that's going up no matter what. So that's something that this can give you a little bit of relief if you are able to lower that interest rate. And yes, it may restart you at 30. We might be able to do 29 and make it still lower your payment for you. But if you just bought and you're resetting to 30, it's not like you had four years of skin in the game where you were paying for it. So I think it's a little bit easier, which that is probably the people that we're seeing now is people that bought in 2023 with refinance. We hope where rates are going to improve and get better, where those people that did buy in 22 maybe have an opportunity to do some of that. And the longer you go between those as well, the more equity you're going to have in that home as well. So that'll allow you to drop PMI and do all types of other things, like we said with the cash out as well. So it opens up more doors and more kind of, I know we got the main 3 bullets, but there definitely are some other bullets a little bit lower than that. Dropping PMI, definitely one of them, and that can pop up too.
Yeah, PMI is a big one. And I mean, the taxes and insurance that you mentioned, we probably will have a whole nother segment on taxes and insurance and escrows and things like that going up.
Not hating on insurance, it's mainly just the taxes.
It really is. It
really
really
just the
is
taxes.
actually. No hate for the insurance people. It really is just the taxes, generally speaking. So those taxes, like Max said, are going up no matter what. So we have a lot of people who their taxes from when they bought the house, they got reassessed, and maybe their taxes went up $150 a month. Well, we can save you $150 a month on your refi and your rate and term. So at the end of the day, your overall payment might not really change, but if you continued paying, your bill is going up because your tax bill goes up. So, like you said, there's a lot more there, but there's one group of people that one group of people that I think should really be paying attention to refinances right now. If you bought a house or did a cash out refi, or if you did a mortgage of really almost any kind in Q3 or Q4 of last year of 2023. So if you did anything in Q3 or Q4 of 2023 regarding a mortgage, I would say the subset group of that is, or you got a mortgage in Q3 or Q4 of 2023 from anybody other than Mitten Mortgage Lending, you should call us.
Yeah.
For sure.
Yeah.
Like, I would be willing to bet if you bought or refied in Q3 or Q4 of 2023, or you did any of that in those terms with another mortgage lender that's not us, I would be more than willing to bet we have a refinance for you right now where you are either lowering your payment or shortening your term for the same payment. That'd be my, Q3, Q4, you guys need to talk to us.
Yeah, and we spent a good portion talking about the lower payment and the shortened terms, but cash out's definitely something that is available. And just like general guideline rules, if you're looking at your primary home, we can only take out 80% of what it's worth. So your new loan can be. So if your home is worth $400,000, $320 is your new loan max that you could get if you did do a cash out. And that's why we say the equity of the home and kind of the longer you may need to wait so the equity grows. If you bought it for $350, we wanted to make sure that it would appraise for $400, that we can get an appraisal waiver or something like that. But a lot of things that I've seen actually is a lot of those people that bought when rates were really low, when there was a lot of money out there, so like 2021, during the COVID era, everyone was getting a little bit extra money. That's when everybody bought investments, it seems like. And a lot of those people are looking to take cash out of those investments because they are, their rent's going up or they're increasing rent on some of their tenants. So if their bill or if their payment goes up on that, it's not as big of a deal to them because they're offsetting it by that, but it opens up some cash flow for them to take money out of that investment. I've seen them take money out just to pay off some of their own debt. I've seen them take money out to go buy a new home for themselves. So
to buy another investment.
To buy another investment, yeah. So the investment, 75%. Again, that's not going to be 80%. 75% is your threshold for what you're allowed to take out if that is an investment property. But I honestly have not seen this many cash outs for just investments specifically than I have in the past 2 months.
Yeah, cash outs are big, especially for the investments like Max said. And he mentioned 80% on your primary, 75% on your investment.
We're talking loan to value, so that your loan can only be 80% of what the home's worth if it's your primary, 75% of what your home's worth if it's an investment.
Yep, and the only thing that I wanted to add to that is, so Max talking 80% if you're doing the regular old cash out. If we look at the home equity line of credit, which is a HELOC, or the home equity loan, which is just a lump sum loan. Those are second liens, so that's us not even touching your first lien. Maybe you did buy in 20 or 21 and you're sitting on a 3%, and that house, and you don't want to touch that 3%. Well, if we go the HELOC or HELoan route, depending on their credit and depending on your credit, we can get you up to 90%.
Yeah.
So we might be able to get, if you're sitting there going, oh man, I'm sitting at like 82%, I don't have any room for any cash out, but I would love a little bit of money to do a project, or I don't know, investment homes can be expensive. Like you got waterproof a basement. You got to do all these things to meet these city guidelines, right, for rentals.
Your favorites.
Yeah, my favorites. So if you if you do need money for some of that on some of your rental stuff, like there may be ways to go above that 80%. But if you have equity and you're looking to tap it, definitely call us. There might be something there. And when it comes to refis, going back, we were talking about, you had a bunch of people send you mortgage statements, and some of them worked, some of them didn't. Well, I can tell you one thing. Those who sent us their mortgage statements and they missed that new low because we were evaluating their mortgage statement, or we were waiting on a mortgage statement, or they were talking to their husband, or they were talking to their wife, and we weren't ready to go when we needed to press go. Well, if you get ahead of it now and you send us your info and we run the numbers and we go through it all and we do it all, the next time that new low comes, and because it happens like that.
We already have it.
Yeah, it's just like the stock market, guys. Like you look at it now and you look at it 5 minutes later and it's different. So if we at least have your info and we know what threshold we need to hit for it to be worth it for you, we can press lock, we can press go on your loan as soon as we see that threshold. So we're not waiting or missing anything, or we're not mistiming anything. If we have your info, this just goes back to what we always say: be prepared. And that's kind of what we always try to do as a company. We try to get ahead of things. We try to be prepared. If you send us your info now, when those new lows come and when those rates do bottom out, because it doesn't last for forever. The rates go down and then they go up. They go down and then they go up. When we hit that bottom, we know we're good to go. And we're not waiting on anything.
Yeah. So we spent a good portion talking about refinances. We always like to talk about or highlight a new product or something else that came out. This one's not really a new product, but just something in general that we see and that we deal with a lot.
Yeah, so it's a
Touchy
topic,
subject.
It's a topic that can be taboo or weird for people, and people don't want to talk about it. Some people think it's embarrassing. Whatever the case may be, we see it all day long, every day. It's just part of what we do. But divorces, and it's not just divorces. It could also be death in the family, a family buyout, buying other family members out of a deceased parent's house. They're all really the same from our end in terms of the guidelines and in terms of the product. But divorces happen, unfortunately. I guess in some cases, fortunately. But divorces happen, and when they do, obviously, a home it's your shelter, so it's more than just a financial piece. It's where you live, you have memories, there's a lot to it. And when it comes to divorces, the separation and the figuring out the house and the refinancing and the getting someone off and then someone else needing that money to purchase, it does not have to be hard. I know, gosh, we talk to people all the time about this, and I know, even just if you guys just read our Google reviews, you will see that there are people who said they helped me through this refinance during my divorce. I thought this would be a nightmare, and it was actually the easiest part of my divorce. Yeah. So it doesn't have to be hard. We can handle both sides. I know sometimes people don't like that. Sometimes people do. It doesn't really matter. It obviously depends on the situation of the divorce. But there are many cases, I would say the bulk of them, where we do both sides and we do it simultaneously, and it's completely seamless.
And I would say it's almost preferable if that happens, because if you do have one party, let's say, that's getting, when the divorce is settled or when this refinance happens, I'm going to walk with $80,000 and I'm going to take that $80,000, I'm going to go buy a new house. Well, if we're handling the refinance that's going to get you the $80,000 and your new purchase, it's really easy for you to go make offers. And when that listing agent calls us and says, is this person been vetted, or, the normal things that we get from listing agents when people go make offers, we can say, they're going through a divorce right now. We're handling both sides of it. It's almost done. Next week, he'll have $80,000 sitting in his account, and he'll be ready for this. It makes things a lot easier on our end, and it is a little bit, I don't want to say it's more of a challenge. It's a little bit more frustrating with us when we do only have one side of it, because normally we are normally faster than the other side. and we're normally more efficient than the other side. So that part of it can be a little bit frustrating, just because I know that someone's going through something that's a challenging time in itself, and it's a little bit more challenging just by not working with the right people.
It is, yeah. Don't make something that's already really difficult and really stressful more difficult and more stressful by working with people who don't even know what's going on. I mean, I don't want to dwell on the divorces and the refis for a long time, but when it comes to a divorce or the family buyout, death of a family member, and we're buying out, a mom or parents died, and we're buying all of our brothers and sisters out of the vacation home or whatever the case is, that's stressful. There's a lot going on. It can already be really hard, but unfortunately, I hear stories of people that didn't call us. They went to their bank or they went to their guy that helped them purchase, and they essentially didn't do it right. Because when you're getting divorced, I guess let's rewind. When you're doing a refinance, I know we said there are 3 types earlier, but there is a rate and term, which is people who want to lower their payment or lower their term, and then there is the cash out, which is when people want to take cash out. Well, technically, most people think, oh, I need to buy out my ex-spouse, so I need to pull cash out of my house, and that's usually what they call and say, hey, I need to take cash out of my house and pay my ex-spouse off. Well, you are doing that. You are pulling cash out of the equity of the home to pay them off. But when you are going through a divorce, as long as we obtain the proper paperwork and we set up the loan the right way, when it comes to rate and term and it comes to cash out, a cash out refi is more expensive. You get a
higher rate.
You get a worse rate.
Yeah.
You get a worse rate when you take cash out than you do if you get a rate and term.
Because to the bank, it's more risky because you're taking the equity that you have, and now you want to borrow that money.
You're pulling it back out of your house. So you had equity, and you said, "Hey, I need it." So to them, it's a riskier loan. So since it's riskier by them, they give you a higher rate for it in turn. Well, when you're doing this divorce or this family buyout, we can take the cash out and pay off the ex-spouse, but we can structure that loan as a rate and term. So you're not getting the higher rate. You are not, paying the cash out penalty. You are not getting any of that. And this is just circling back to a little bit more what you talked about. You mentioned, hey, when we take cash out, we can go up to 80%. If we do a divorce buyout as a rate and term, like we talked about, you can take up to 95% of your equity. So if you and your wife bought a house, or you and your husband bought a house a year ago, and you're like, oh my gosh, we don't even have equity, but I don't want to leave the house, but I don't know how this is going to work. Well, we don't need you to have 80% because you are taking cash out, but the way that Fannie Mae and Freddie Mac see this, it is not a cash out. It's a rate and term as a cash out. I have, unfortunately, this is where I was going before I went on this long tangent here, but I have unfortunately seen people who came to me after the fact and said, yeah, I went to my bank, they all did it, we set it up, we did it, it's a cash out. And I'm like, what do you mean? And we look at their paperwork together, and they did a cash out.
Yep.
So they paid for a cash out, they have a higher rate, they have a worse rate, when if they would have spoke to someone who knew what they were doing, they wouldn't have that higher rate, and they wouldn't have paid all those adjustments, and ultimately they would have had a better loan.
Yeah, so anytime you're going through divorce and you are getting cash out to pay somebody off or something, that should be a rate and term. That should be a rate and term loan. And there's not, I'm sure you might be able to. I can't think of really any other instance where you get to take that cash out and still do that rate and term.
There are
probably the family buyout might be the only other one that you mentioned.
Family buyout. I'm sure there's something weird in the guidelines somewhere, but no, there are no other circumstances where Fannie Mae and Freddie Mac let you access the equity in your home without essentially penalizing you for it.
Yeah. So that's something we've handled a lot here. Again, touchy subject. Obviously, we're very discreet with it with our jobs and everything. So yeah, if you have that situation, or if you have somebody that you know is going through that situation, have them reach out to us, and we'd be glad to help them through that difficult time. And then, so last topic here, which is so weird and so depressing because it means summer's over with, but that means it's coming to that back to school season, which means it's the end of buying season. That's rapidly approaching.
Purchase season is over.
Is starting to slow down because a lot of people leave. They looked for homes all through the summer, but now kids are settled in school. School starts in a couple weeks. Football's getting started, middle school started, whatever. And now they're going to put buying on the back burner and wait until next year. So that opens up opportunities for other people that have been sitting there waiting, because now things, relatively speaking, should get less competitive.
In theory, I think things should get less competitive.
But now rates are going down.
But rates are going down.
So who
So here's the thing. When it comes to back to school time, and I keep using the air quotes, purchase season is over, because for us, I don't really think purchase season ever really needs to end. You buy a house when you buy a house, but generally that's why they call it purchase season, right? It's the summertime, kids are out of school, everyone's moving.
Wait till your kid's in school, you'll think differently.
Yeah, I'm sure. That's a whole nother podcast topic. We're gonna have
It's a long one.
But so generally, when purchase season ends, there's less competition. What I think, and kind of what you just said, rates are supposed to drop. Again, who knows? Who knows what the future is going to bring? We've got an election coming. There's a lot of uncertainty out there right now. But if these rates do drop, like they're projected to, like the Fed says they're going to, like everyone's been saying they're going to, if they do drop, I think we might solve a little bit of this inventory problem that I know these real estate agents are seeing out there, and obviously these buyers, people who are anyone who's shopping. If you've been shopping for a home or if you already bought a home, I'm sure you're well aware at this point of the lack of inventory that's been out there. Just not a lot of homes have been for sale. Well, in my theory, a lot of people, like you said, everyone bought 2020, 2021. There was a massive surge of people buying houses. I think a lot of people that are sitting in those at 3%, when these 5% roll back around, they might be willing to. Nobody's really going to come off their 3% and trade it in for a 7%. It's much more reasonable, though, to trade in your 3% for a 5%, especially if your family's grown. If maybe you just hate your house. Maybe you hate your neighbors. I don't know. I don't know what the reason may be. But I think all these people that are sitting on their low rates, sitting on their low inventory, if they've even thought about selling or doing anything, as soon as these rates trickle back down a little bit and the payments are affordable again and it's manageable again, I would really like to think that we see a lot more houses that kind of start popping back up. So it might be a little, inverse to when purchase season really is, but I at least hope that that's coming. So if you've been striking out and if you've had a rough go at it and if it's really sucked for you, if you've just had a bad experience shopping, maybe you gave up completely because you just couldn't find anything or you didn't want to fork over a $30,000 appraisal guarantee, now might be a really good time.
Yeah, keep paying attention, especially over the next month and a half, 2 months coming up, because that's when hopefully we would expect to see things get maybe a little bit less competitive for your situation, and maybe even possibly some more inventory getting out there too. That would really be kind of the best of both worlds if that were to happen. But again, like you said, a lot of things are going on right now. A lot of things are changing. Election coming up. We could see the rates dip down. So yeah, maybe it's not as competitive, maybe it stays competitive, but maybe there's more opportunities out there for you. But if not, relatively speaking, this is normally when we see a lot of people exit the buying part of it or the buying game, and they're taking themselves out of the game for a little bit, and they'll sub back in April or May when school season's over with. But that is coming up right now, so make sure that you are paying attention to that.
Yeah, no, you're spot on. A lot of people that maybe shopped all spring, all summer, and came up with nothing are going to hang it up or might hang it up and say, you know what, we'll revisit this next year. Like you said, kids are in school, football started, whatever, all this stuff's going on. Well, if you are one of those people who's thinking about hanging it up but don't necessarily want to or need to.
Maybe you're moving within the same district.
Yeah, or maybe you're staying in the same school district. Yeah. Exactly.
Maybe you have no kids.
Or maybe you have no, yeah. If you're one of these people who might be thinking about dipping out of it, I would just keep your eyes and your ears peeled, because I do think I think some of your competition is walking away right now. Yeah. Some of the people that you've been battling over these houses with are walking away right now, and they're going to take a break. You might be able to find something out there that you just haven't been the last couple
same
months.
thing relatively speaking. I think the best deals that people get on homes is when they purchase in, October, November, December. That you can
especially here in Michigan. Nobody wants to. I don't want to move.
Right, exactly here in Michigan. So anything else to add before we wrap this one up?
No, I don't have anything else. I mean, again, I know this message, I'm sure I say this every time, but there's really no dumb questions when it comes to this. If you're curious, if it might be time to refi, or if it might not, or even if you just, I get this one all the time. Hey, my wife and I, my husband and I don't want to buy until next year. We're in a lease right now. We're in an apartment, but we know we're buying a house. I get my messages here is just don't wait. Just get a hold of us. Nothing bad is going to come from us talking through things with you, giving you an idea. I can't tell you how many people don't understand that your cash to close is more than just your down payment. So they say, I've got 10% saved. Well, great. You want to put 10% down, but do you have the money for the taxes, for the insurance, for the title, for all these other things that you're going to need? So a quick conversation, a 5, maybe 10-minute tops phone conversation right now might prep you so that in a couple months when you are ready to pull the trigger, we're not solving problems then. So
You're prepared.
Back to what I was saying, be prepared. Call us. Like, there's literally no dumb questions. We're not going to be mad at you. You're not wasting our time. That is, if you're not calling us to ask questions about your refi or your purchase, we don't have anything to do. So call us. We're happy to help. If it's not the time, we're not going to push you into something that isn't right for you. And if it is the time, we're gonna help help make you realize what's going on, and we're gonna help make sure, more importantly, that you understand everything that's going on.
Yeah. So real simple, like we kind of always say, who you work with matters.
Who you work with matters.
Who you work with really matters. So that's all for this episode of the Mitten Mortgage Lending Podcast. Again, accepting name recommendations still. I really hope that doesn't stick because we need something a little more catchier than that. So thanks for tuning in, and we'll catch everyone the next time.